Hello there, welcome back to my channel. In this video, I want to look at a question from a question paper of June 2025, and we are going to look at a question on absorption costing. So, the first part of our question 5.1, it reads, and the following information was extracted from the records of our fabulous trial makers at the end of financial year 31 July 2022. So, they're given a list of balances, and then on the required part, you have to prepare the income statement according to the absorption cost method. So, our question has got 11 marks. So, remember, the absorption cost method takes into account all the costs, that is, it takes into account the variable cost and the fixed cost, which is different from marginal cost method, whereby marginal only takes into account the variable cost. So, we have to take note of that. So, in terms of our answer section, this is what we have. And of course, we are supposed to start with the figure for sales. So for absorption costing, we are going to say sales minus a total cost. That is a total cost. We're going to include the variable and the fixed. So the first item is sales. Then we check according to our question what we have in terms of sales. So you see that we're given total sales in units is 180,000. 180,000 units, and then we check the selling price per unit. We see that we are given it in the last part. We've got 65 rands as the selling price per unit. So to get the total value of our sales, we're going to say 180,000 and multiply by 65 rand. So in brackets, we just indicate the calculation whereby we are saying we have 180,000 and then we multiply by 65 rand. And then the total that we are going to get is 11,700,000. So basically, this is what we have for that part. And then we are supposed to subtract the production cost. We are supposed to subtract the production cost first. Remember, in the production cost, we are going to have the variable production cost whereby we have got direct material and direct labor as the one that we are going to subtract first, and then we go to the other fixed manufacturing overheads, and also we can have variable manufacturing overhead. We are also going to include them since we are going to include all variable and fixed. So here we say less total production costs. So other total production costs, we'll check what we have according to the question. So we have got direct material. We check according to the question that we have. Remember, we are looking at 5.1. So we refer back to our 5.1 and we see that our direct material, the figure that we have is, we're given direct material per unit, which is 9 rand 50. So to get the total direct material, we're going to say the per unit 9 rand 50, and then we multiply by the total units. We multiply by the total units to get the total direct material. Of course, we have 180 is indicated, 180,000. So the first that we have is direct material. Then in brackets, we show the calculation whereby we are saying 9 rand 50 times 180,000 to get the total for direct materials. And then you get a product of 1,710,000. So that's what we have on that part. And then, of course, we check in terms of the next that we have is direct labor cost, which is 9 direct labor cost, which we are given is direct labor per unit 10 rand 50. They give it is 10 rand 50 again, which is per unit again. So which means you're going to say 10 rand 50. We multiply it by 9, we multiply it by 180,000. So basically for direct labor, we are saying we have got a unit, of got 10 Rand 50, and we multiply it by 180,000. So multiply, let's see what to get. Then you get 1,890,000. 1,809,000. So we can just go and summarize the wiki in our brackets. So here we've got direct labor. Whereby we are saying 10 Rand 50. And then we multiply by 180,000. So we calculate like that. You see that you are going to get is 1,890,000. So this is what we for direct labor. Then we check of our manufacturing overheads costs as part of production cost. So you've got fixed manufacturing overhead is 650,000. Fixed is 650,000. We've got 650,000. And then we check in terms of the next one that we have is we have got variable manufacturing overheads 770,000. So that's what we have on the part of production cost. So to get the total production cost now, we add 1,710,000 plus 1,890,000 plus 650,000 plus 770,000, and then we get a total of production cost, which is supposed to come here is 5,020,000. So if we subtract it, since we are saying less, you say 11,700,000 minus 5,020,000, you get your answer here is 6,680,000. And the figure that we have here is now our gross profit. Then from there, we are supposed to subtract other expenses, which we have as total selling and administration costs. Total selling and administration cost. And admin. So we check in terms of the values that we have for that. You see that we are given our selling cost as 55% of variable, which is 550,000. 55% of variable, which we are given is 550,000. So it means this selling cost that we are given, 550,000, is 55% of variable. That's what the question is just trying to illustrate. So we go there and indicate it as our selling cost. So we are saying selling cost and then the amount that we have is 550,000. And we check in terms of the next one that we have is we're given administration cost again, which is 60% of fact fixed, which is an amount of 680,000. So administration, we've got 680,000. So we add the two to get the total selling and admin. We get 1,230,000. And remember, we are saying less, so also subtract. So if you say 6,680,000 minus 1,230,000, you're going to get a net figure of 5,450,000. And this is our net profit. So basically, this is what we have. So the 5,450,000 becomes the net profit according to the absorption costing method. So I'm moving on to the next part of our question, which is now 5.2. 5.2 reads below are the results from the financial records of JJ Plastic Private Limited, who produce plastic water bottles for the period ending 31 July 2022. So first part is saying calculate the marginal income per unit and round off your answer to two decimal places. Remember the marginal income, we are going to say our sales, and then we subtract the variable cost only. We subtract only the variable costs, and then we get um, the marginal income. So to get the marginal income now, we divide by the number of units, which is 1,000 units, to get the marginal income per unit. So with that, we can calculate it by saying. So we are saying marginal income is equals to our sales minus the variable cost. And to get the marginal income per unit, we are now divided by the total number of units. So let's start by calculating the marginal income, whereby our sales, we are given it as 1,000 units, of which each unit is got is 50 rand. So we say 1,000 times 50 to get our sales. So we are saying to get our sales, we are saying 1,000 units times the 50 rand per unit is our selling price. Then we subtract the total for variable costs that we have in the question. We check variable costs. We have 8,000. We have got also direct labor cost 9,500. So we add them in brackets. Whereby we are saying 8,000, and then we add the 9,500, and then we add the other variable cost that we have in the question. So if you go down, you'd see that we are given manufacturing overheads fixed is 50%, which is 5,000. So the variable is going to be the remainder 50%. So if 50% is equal to 5,000, then the other 50% also is equal to our 5,000. So as simple as that. So we take our 5,000 and add it again. So we add it here. In terms of the next one now, we have got selling and administration cost, which is 65% variable, 4,000. 60% variable, we have 4,000. Then what about the remainder? The remainder now is what we want to calculate. So we can calculate, as we are saying, this 65% is a variable, which is 4,000. So what it means is we have our total is 4,000. The total selling and administration cost is 4,000. Then the variable part is 65, 65%. So obviously we are going to say 65% and then we multiply by 4,000. So if the variable, total variable is equals to 65%, and then the total selling and administration is 4,000. So to get the variable part, you're going to say 0.65 is or 65% is decimal, and then you multiply by 4,000. So that you're going to get it as 2,600. So this is going to be the selling the variable selling and administration. So with that now, we can now calculate by saying we can now calculate by saying by showing it in our other section. We come to our other section. And we add our 2,600. So we add our 2,600. And also, if you refer back, you'd see that in terms of our 5,000 again, this 5,000 that we have of manufacturing overheads becomes the total of our manufacturing overheads. And then the fixed is 50%, which means the variable is also 50%. So you're going to say 50%, which is 0.5, and then you multiply by 5,000. And you get your answer is 2,500. So in this case, it means we have our 2,500, which we are supposed to also include there and remove this 5,000. I mean, this 5,000 is not correct. So we can put our 2,500 on this part. So basically, that's what we have on that part. And then with that, we have exhausted all the all the variable costs that we have. So we can now add to get the total. And then if you add there, you see that you're going to get your total is 22,100. So we say 1,000 times 50, and you get your answer is 50,000. So we are saying 50,000 rands minus the total of variable that we have inside the brackets, we get to 22,100. And we are going to get your marginal income is, if you subtract, you get your marginal income, which is going to be 27,900. So this is what we have on this part. So this becomes your marginal total marginal income. Total marginal income. So now to calculate the marginal income per unit, remember uh, we have got 1,000 units. So we're going to say one marginal income per unit is now equal to total the marginal income that we have is 37,900, and then we divide by 1,000. So get your answer is 27 Rand 90 cents per unit. So this becomes your answer on that part. Then from there we move on to the next question. We now go to 5.2.2, says calculate the break-even quantity. Round off your final answer to the next whole number. Break-even quantity. So on 5.2.2, break-even quantity obviously is total fixed cost over marginal income per unit. So we say this is our 5.2.2. So break-even quantity is equals to our total fixed cost, and then we divide by marginal income per unit. So total fixed cost, we check in terms of our question. What do we have in terms of total fixed cost? Remember, on the first part, we calculated we got 2,500, which is the same fixed and variable when manufacturing overhead, since it's 50-50. So it means we've got we've got 2,500 as one of the fixed costs. Then we add the other parts whereby we say selling administration 65% is variable, which means we are having 35%, which is fixed. So if you say 35%, which is 0.35, multiplied by 4,000. If you multiply by 4,000, you're going to get your answer is 1,400. So this 1,400, you're going to add it to 2,500. And then the answer that you're going to get, you divide by the marginal income per unit, which we calculated, and we got 27. We calculated marginal income per unit on the first part, and we got 27 rand 90 cents. So that is going to be our denominator. So we do that. We are going to say that the answer that we are going to get when you divide, you add, you divide, we get 140 units. To the nearest rand, 140 units is the break-even quantity. So this becomes your final answer. So that's what we have on 5.2.2. Then we move on to the next part, which is now 5.2.3. Calculate the break-even value. Break-even value. Obviously, break-even value is break-even quantity times selling price per unit. So you're saying 5.2.3 needs us to calculate break-even value, which is equal to break-even quantity times selling price per unit, of which break-even quantity we calculated and got 140. Then we multiply by selling price per unit, which we are given as 50 rand. So you multiply by 50. So we do that. We see that the answer that we are supposed to get is 7,000. So this becomes the break-even value. So moving on to the next part of our question, is saying calculate the safety margin. Calculation of the safety margin is safety margin ratio. So formula for safety margin ratio, this is 5.2.4. Safety margin ratio is equal to sales minus break-even value minus break-even value. Then we divide by sales minus break-even value. Then we divide by sales. Then divide by sales. You multiply by 100 over 1 to express it as a percentage. So of course our sales, we did calculate our sales, and then we got on the calculation of our sales, we said 1,000 units times 50 rand of sale price per unit, we got 50,000. So it means here we've got 50,000 for sales. And then we subtract your break-even value. The break-even value, we did calculate it in here, and then we got what? 7,000. Then we divide by your sales, which is 50,000. Then we multiply by 100 over 1. So we can calculate like that. You see that the answer that you are going to get is 86%, obviously to the nearest whole number. So this is now the safety margin ratio. So we go to the last part, which is saying if margin safety is given as 650 units, calculate the break-even units. So obviously, to get the break-even units, you are going to say your sales minus your margin safety. So remember, our sales number of units for sales is 1,000 units. Then you subtract your margin safety. So 1,000 minus 650. When you do that, you're going to get your answer is 350 units. So that becomes your final answer. So this is what we have, guys, according to this question on absorption costing and marginal costing. And thank you for listening, and let's meet again in the next video.